Hi everybody, this is James Tompkins and welcome to lecture 13 and the final lecture of this international finance series that I've done. So as I'll always do, I'll even put this final lecture into perspective. Why are we doing what we're doing? Well, the theme of this class was what? International financial principles as it affects firm value. And value is a function of risk and return. And the element of risk that we've been looking at that one might associate with international risk, exchange rate risk, right? But at this point, especially after the last lecture, you should know that it's actually a pretty important risk even if you're a purely domestic firm, as we discussed in the last lecture. And so we've been looking at why the dollar goes up and down in value and understanding why the dollar goes up and down in value and using that as a platform from which to look at other different types of currency movements and other forms of international risk. And in the second half of these lectures, we basically have been looking at managing this risk and managing it not just in the short term but also the long term. So today I want to look at one more final kind of risk, if you will, and that is political risk. And I'll obviously show you what the agenda is, and the agenda will say, well, what is political risk, and how do we measure it? And by the way, how do we manage it? So let's begin with what is political risk. So when you think about the risk, do you think about the expected or the unexpected? Well, presumably the unexpected, right? So for example, for me, there is zero risk that the sun will not rise tomorrow morning. Why? Because every single morning of my life, it has risen, right? So nothing unexpected has ever happened when it comes to the sun rising. So when you think of risk, presumably you would associate it with the unexpected. And so we could define political risk as basically a change in firm value because of any unexpected government or political action, or for that matter, even threat of action. So let's think of some examples. In fact, I'll begin with threat of action. Okay, I know occasionally here in the United States, presidential candidates have sometimes made drug companies the bad guys. Hey, you charge too much money for this medicine, and so on and so forth. And I'm not saying they're right or they're wrong, but irrespective of that, when a presidential candidate makes such a statement, ceteris paribus, all else being equal, how do you think the stock price would react to or for the drug companies? Well, it'd probably go down, okay, assuming there was a reaction. And the reason it would go down is because even though no law has been passed saying at that point in time, hey, you have to lower your prices, there's a possibility that it might. So no, it's threats would be an example that would have an impact on firm value. What are some other examples? What about war, right? Would you expect war to impact the valuation of companies? Well, it could, right? I mean, it could impact it positively if you're a defense company. It could hurt it negatively if maybe you're a vacation company and presumably less people go on vacation if there's a worldwide war or whatever. It might be that your company is totally expropriated. And what do I mean by expropriation? Well, expropriation is where, or outright expropriation, is where what you own is completely confiscated without any compensation whatsoever. Okay, so maybe you have maybe you have an oil refinery in Venezuela, and the Venezuela minister shows up one day and hoists the Venezuelan flag and says, so sorry, but this now belongs to us. Partial expropriation would be, all right, well, we'll pay you part of the market value for it, or whatever. And so an example would be when, going back maybe 100 years now, when the Tsar was overthrown, right, and private property abolished. What else? What about terrorist attacks? Sure, that could have an impact on the firm value, right, and did. What about something maybe less dramatic? How about a 0.5% tax increase? Would that have an impact on firm value? It would, right? So those are all basically examples, and we could probably come up with a number of examples of political risk. So let's look at measuring political risk. How is political risk measured? Well, basically, it can be measured on a macro or a micro basis. And what do you think the difference is between the two? Well, basically, micro is looking at the risk of a company going abroad, and macro is basically looking at the country. Okay, how risky is the country? We can look at different, for example, country risk indexes that exist out there. There's for example, the Business Environment Risk Index. Every year, the Wall Street Journal, in collaboration with the Heritage Foundation, they come out with something called the Index of Economic Freedom. And so my question to you is, well, what kind of things would you put in that index? Well, what about how free a country's trade is? Ceteris paribus, do you think that would make things more politically risky or less politically risky? Probably less, right? What about how frequently regimes are changed? So how frequently, say, in the United States, you go from Republican, and then 4 years later back to Democrat, and then back to Republican. Would you say that was more politically risky or less? Probably more, right? What about the type of government you have, whether it's a democracy or a dictatorship? I mean, obviously there's judgment involved with what you'd put in these indexes. What about some economic stuff? I mean, for example, the rate of inflation. But what would the economic condition of a country have to do with how politically risky it is? Well, on average, do you think a poorer country is more likely to be politically risky, or a prosperous country? Well, I could be wrong. I would guess a poorer country. What about a country in which there's a huge gap? So there's between the rich and the poor. So there's a small pocket of very rich people, and there's practically no one in the middle, and then there's a ton of poor people. Would you say that's ceteris paribus more politically or less politically risky? Probably more politically risky, right? In any case, if you look at you could Google it, right? If you look at the Index of Economic Freedom, like I said, the Wall Street Journal puts that out once a year. Basically, what they have found, and I'll ask you, what would you guess? So they rank countries according to how free they are, okay, which includes both economic and political measures, and they look at some measure of prosperity. Okay, so maybe it's GDP per capita or something like that. So what would you guess? Would you guess that the more economically free a country is, that it's more prosperous on average or less prosperous? Well, they find that it's more prosperous on average. Okay, and by the way, it's not just the rich at the expense of the poor. So, for example, where would you rather be poor? Would you rather be poor in, say, a country like the United States, or would you rather be poor in a country like, say, Zimbabwe? And the answer is you'd definitely much rather be poor in a country like the United States. So that's a little bit about measuring political risk at the macro level. And basically, since political risk is different to different companies, when we think about it at the micro level, It's not just good. It's not just good enough, for example, for Coke to say, all right, well, this is how risky, say, Zimbabwe is. Coke needs to go through the thought process of, well, this is how risky it is for Coke to go into Zimbabwe. And so in managing political risk, basically a thought process is that expropriation will occur if the benefits of expropriation to the country exceed the costs. And so if that's the case, if Coke, say, going into Zimbabwe are going through a thought process of, well, how beneficial is it for Zimbabwe to take our syrup plant or take our bottling company or whatever it is, okay? And then they think about, well, how costly would it be to them? Okay, well, if it's more beneficial than costly, then what can Coke do to that? Well, in principle, would Coke want to, if there were such actions, and we'll discuss these actions in a minute, but in principle, would Coke want to do whatever it took to keep the benefits of expropriation low? In other words, we'll go back to the Venezuela example. So the minister shows up to the oil refinery or whatever, and so if the oil refinery has put mechanisms in place that do not make it very beneficial for Venezuela just to confiscate their oil refinery, would that be a good thing? Would that make things less politically risky or more politically risky for the oil refinery? Make it less politically risky, right? And so basically, the thought process is, well, what I want to do is, if I'm going to manage political risk, I want to keep the benefits of expropriation low to the country that might expropriate, and also at the same time, the costs high. And so that's a thought process. So let's get into some examples. Now, the first example relates to timing, okay? When do you think that a company is in the best position to negotiate maybe some conditions that they want in place that make political risk lower? Right at the beginning, or maybe when they've already set up shop, or towards the end? Well, let's take for an example. I'll take myself, okay? And this relates to living in an apartment. I remember when I moved to Chicago a number of years ago, I had to rent an apartment, right? And so I'm looking at various places, and I come to this place, and they say, hey, you know what? If you come to us, we'll give you, and I don't remember the details, so I'm making this up, but we'll give you, say, 1 month's free rent. And I go, great, all right. And so I move in, and now a year later, okay, do you think they offered me a month's free rent? No, because I was already established. I was already set up. They knew it'd be costly for me to look for another place and move my stuff and so on and so forth. And so, in other words, my best time to negotiate that free month rent was at the very beginning. And the same concept would apply right here. So managing political risk, the best time for a firm to bargain is before they've put any resources or any significant resources into that country. So let's look at some specific approaches to managing political risk. Now, number one, if you wanted to, you could just avoid it, right? And that's fine, but if you avoid risk, then what do you also give up? Well, you give up potential reward or potential return, right? So, for example, a number of companies have wanted to be in China as China has come more and more on stream. So they've wanted to be in the right place at the right time. Now, it could also be argued that if you want to be in the right place at the right time, that you have to have pretty deep pockets, because you have to be able to sustain a potentially risky environment for a long time before it pays off. But in any case, It is a thought process. I've read of companies that were in China for years and years and years, and they finally lost patience and they moved out. What's another thought process? I mean, think in terms of, say, the balance sheet. Okay, so here we have assets, and here we have, maybe it's the assets are funded with, say, debt and equity. Okay, so let's say you're a grocery store chain. Maybe you're Kroger's or you're Publix, and you're thinking of venturing into Mexico. Okay, well, what would be a way to make it less politically risky, say, on the asset side? What could you do? Remember, the thought process is to keep the benefits of expropriation to the country, so in this example, Mexico, low, and the cost high. Well, what if you did a joint venture? What if you joined up with a local company and said, hey, we'll have this grocery store together. We'll share it. So if Mexico came in, they said, all right, well, now we're taking over this grocery store, then would that make the local company mad? It would, right? And so would that be costly to Mexico to just taking over that grocery store? All else being equal, would it make it more costly? It would, right? In fact, when you think about a natural progress that some companies engage in as they maybe go from being domestic to international, is first they might maybe just export to countries, then they might have licensing agreements, then maybe joint ventures, and then maybe eventually sole owners as they're abroad, right? The thinking is, well, when you get into a hot tub, do you just dive right in? You don't, right? I mean, you might stick your finger in and just to see how hot it is. And then maybe you might just gradually get in. And it's the same thing here. So other issues, well, we've already talked about this one, negotiate concessions in advance. But let's get back to this. What do you see in the context of the balance sheet right here, as far as what the company could do to make political risk negative, negative consequences of political risk less likely? Well, what about this side? Let's say they're borrowing money, or they're raising equity, or whatever it is. I'll give you an example. Okay, Disney. Okay, when they set up Eurodisney, okay, they could have just, Disney could have funded the whole thing, right? And Disney could have just owned Eurodisney outright. Okay, but one of the things that they did was they raised financing in the local country. Eurodisney ended up in France. Well, they raised financing in Europe, okay, including France, and also, by the way, they borrowed from the French government. And so, with that, would that make it? If France came in and said, all right, well, we're going to take over Eurodisney, would that make any French investors and European investors mad at them? He would, right? And by the way, if Disney had borrowed money from France, and then France, so they borrow money from France, and then France comes in and says, we're going to take over Eurodisney, what would that do to the motivation for Disney to pay off that debt? They might go, well, forget it, right? So again, does that make it beneficial for that expropriation to occur? It doesn't, right? In fact, it makes it very costly. Okay, because not only would the French government make their own French citizens mad at them, but they'd also make other countries surrounding France mad at them. And another thing you can do is you can, in a sense, create an alliance. So, for example, one one of the things that, again, getting back to the Eurodisney example, one of the things that the French government did was they said, hey, we'll sell you land at 1960s prices. And Eurodisney, I think, was put in the 90s. And they said, hey, we'll build the subway or the underground or the tube or whatever you call it. Whoever's watching this, we'll build a train that goes from Paris to Eurodisney. So with all that in mind, would it be in the best interest for the French government to have Eurodisney thrive and survive? It would, right? And would that be more likely or less likely if France came in and expropriated Eurodisney? Make it less likely, right? What's another thing that can make political risk less likely, or how you can manage political risk? Well, let's look at the Coke example. I mean, I find this hard to believe, but apparently, Coke syrup is secret, right? That recipe is secret. I'm just, I mean, if we can map out the human body DNA, to me, it's hard to imagine we can't figure out what is in that Coke syrup. But in any case, so imagine it's secret, and the Venezuela comes in and says, well, we're going to take that bottling company. Well, what could Coke do to make it less beneficial to Venezuela to expropriate the bottling company? Well, they could just say, hey, we're not going to provide the syrup, right? So another way to manage political risk is to keep some sort of ongoing dependence with the parent company. And then finally, there's liquidity. So let's say you're a consulting firm, and I'll use Venezuela. I'm not picking on Venezuela. I guess I am, but I just have to randomly pick a country as an example. Okay, so let's say you're Venezuela and you're a consulting firm, and the country Venezuela is thinking of expropriating the consulting firm. Well, where's the value in a consulting firm? Would you say it's with the people? Or would you say it's with the building that they're in? Well, probably the people, right? In fact, they may have even just rented or leased the building. And so if Venezuela comes in and says, right, we're taking over this consulting company, well, what do? Well, you just put the people on the plane and ship them back home to headquarters or whatever and give them assignments in different parts of the world. And so that would be an example of liquidity, the ability, if you will, to pull out. And the more cost-lessly you can pull out, then the less you are subject to political risk. And so those are all examples of managing political risk. And this concludes the international finance series. The goal was to get across international financial principles as it affects firm value. And we said value is a function of risk and return. And so we've looked at exchange rate risk and different forms of international risk and political risk. And our goal has been to not just manage these kind of risks, but actually to thrive and celebrate risk opportunities that exist out there because the world is so different. In any case, I hope you've enjoyed this series. I hope it's been a really positive learning experience, and maybe I'll see you in some of my other series, like the corporate finance series. Thank you, and goodbye.